Evening. Good afternoon, everybody. Welcome to the DFL class that Scott Forehand runs every 2 weeks. My name is Tom Deutsch. I am an agency owner with Symmetry Financial Group, Director George and Janet Matthews. And Scott, appreciate you taking the time out to give us some additional and more advanced training. I understand you mentioned taxes are on the agenda tonight, one of our favorite subjects, and looks like we've got a special guest too. So I'm going to hand it off to you, okay?
All right, thanks, Tom. Thanks everybody for coming tonight. Tonight we do have a special guest, Mark Creighton, Vice President of Mutual Trust Life. Welcome, Mark. Thanks for joining us, and thanks for imparting some wisdom into the folks this evening. So if you wouldn't mind, please go ahead and introduce yourself and give you a few minutes to talk about some of the stuff we talked about earlier.
Yeah, absolutely. And thanks. I have to impart wisdom, setting the bar high on a late Thursday. As Scott said, I'm the Regional Vice President at Mutual Trust. I've had the opportunity to reach out and thank many of you on the call for business that you've done, or talk to you along the way for things you've needed some help with. And we really appreciate every opportunity. From the top down of the organization, we understand that we owe a great debt of gratitude to you out in the field. We exist for the benefit of our clients. We don't get those without you. So always, if there's anything we can do to support you, let me know. I'll share my contact at the end here if you don't already have it. A few things going on in the company. The biggest story, bomb dropped on us, the insurance industry as a whole at the very tail end of 2020. The CARES Act that they passed included a little blip of a thing that related to the insurance industry. And it related to the 7702 rules, which defines what life insurance is, and more specifically addressed the guaranteed interest rate. It was important that they did that for the life insurance carriers, as specifically your whole life. In the IUL world, they were working with a lower rate, so it doesn't really impact them. They were able to pivot pretty quickly to repricing their products. Your whole life carriers, however, have a little bit more work in front of them. They have to strip down and change everything they're doing with their products. So come first week of January, we found out they slipped that through, and we were given parameters to work with in terms of what guaranteed interest rate we used. And we've been hard at work repricing our products, testing the scenarios, and now we're to the point where we're filing. The great news is it's going very well. In fact, we already heard from California, which is a mild miracle. But I think all the states have been really great, because this isn't just a little repricing. This was a very short window. Just for some comparison, when we did our last CSO, that's the table we use for mortality rates. Now I forget what the standard ordinary. We had about 2 years to work on that. So that's a much easier process. This was, let's do everything on the run in a full dead sprint. Scott and I were talking earlier, and I did mention the guaranteed interest rate changes. And like you, I once heard that this has been talked about for a long time, 10 years. The interest rate environment we're in is difficult to continue to do what we're all doing, having to maintain products at a 4% guaranteed interest rate. The investment market that whole life carriers live in isn't producing the kind of yields we need to make life easy and provide great dividends. You've seen dividends come down. It's specifically because of the interest rate environment. Having to live to that 4% interest rate makes life really tough. Things were going to have to change, whether it was comp, something else, the way products performed, higher pricing, something was going to need to change to address that if they didn't change the interest rate. When I first heard about this, let's call it 5 or 6 years ago, I sat down with my actuary team and I said, what does this mean? I'm scared to death for what it means for, what you call DFL, infinite banking, really cash accumulation strategies. What does that mean? It scared me, thinking this is not going to be a viable concept anymore. I walked away from that meeting understanding it really isn't going to change much at all. It's going to change how much death benefit your premium dollar buys. But in many cases, our DFL cases aren't about the death benefit. It is an absolute great benefit that we should never discount, but it's not the driving factor to what's creating the sale. So there's a few advantages having less death benefit and ability to put more money into the PUA or drive early cash. There's some definite benefits there. Long story short, fear not. As a company, I tell you, we value you. We really value you. We had conversations with people who do the types of business they did, and we said, what are you looking for? What are your trigger points? What matters when you're talking to clients? We know the DFL business, the IBC business really well. We knew what those answers were already. We've gone around to our other agents who do other things and say, kind of exploring what's going to matter, what won't, where do we have leeway, where don't we? And we've got really creative in how we're going to price the products. So I'm here to tell you that the new DFL product, the new product we're going to use for DFL is going to work every bit as good as the current one. In fact, we're even adding a 20-year term rider to make life just a little bit easier and simpler when you're creating these plans. So that's some great news. We've got, today I just got the first bit of news on what the product launch will look like. We'll make that public just as soon as we can. So stay tuned for that. I know there's going to be a big product webinar we're going to do at the end of September. All agents are invited to attend. It'll be hosted by my boss, the Chief Marketing Officer. He will have an actuary present just to talk about some of the challenges and what we faced and how, all that we needed to do. And really what I hope you'll walk away, if you have an opportunity to attend that, is an appreciation for, we do care what you're doing, and we want to make sure you've got a story to tell with us still. Other news, we continue to work on our e-app. We know many of you would like to see that, and we'll have that available just as soon as we can. We're very excited to offer that and make life just a little bit easier. We've had to do some things to get creative to help you do business in a pandemic, and I think we're proud of what we were able to accomplish. But we want e-app more than you do. Put it that way. As soon as it's ready, we'll make that available to you as well.
Hey, Brooke, is that the e-app that you're looking at? Is that going to be an IGO e-app?
It is not IGO. We took a look at the different platforms, the different programs that are offered out there, and there was some evaluation on IGO that made it a little less attractive for where we plan to go after e-app. So with some of the systems, and it's also a enterprise-wide project. Enterprise meaning our friends at Pan American, our partners. They do some business internationally, and this was something that was going to adapt well to all the systems that we have in place.
Okay, understood. Well, thank you very much for coming and joining us, Mark. As always, your help with all the stuff that we do here, especially with Mutual Trust, is greatly appreciated. And if you're an agent and you hadn't had an opportunity to work with Mark, then you're missing out. So thank you very much, Mark. All right, so let's go ahead and get rolling here. I'm going to go ahead and share my screen. This is what you were looking at before when we first started. And this is what the initiative that we have here, that we're trying to do here, is all about. And we have a goal, a corporate goal at Symmetry is to eliminate $1 trillion of consumer debt. And I think that we're going to get pretty close to it. So let me do this, restructure this. There we go. And now we're going to go right into our DFL. All right. So this is the standard presentation that I do every couple of weeks. Nothing new here. You guys have an opportunity to see this. This is just the debt-free life program that's specific and proprietary to Symmetry Financial Group, something that we came out with in 2019, May of 2019. And as Mark was mentioning, there's other programs that are out there, other systems that are out there that have been utilizing some of the concepts and financial concepts that we talk about here for a long time. And I think Mutual Trust was actually one of the first companies ever to offer this program back in the early 20th century. But there's no but here. So that for me, there's a certain confidence level that I like working with certain companies, and Mutual Trust is certainly one of the companies I like to work with because of their history and their exposure and experience with this particular product or something similar to Debt-Free Life. Anyway, Debt-Free Life is a proprietary program. It's really a play on words. We're going to use debt to create a debt-free life. We're going to turn debt on its head, change the paradigm, and put you in a situation where you're actually using your debt and your debt service to help you pay off all of your debt and create a major tax-free retirement income stream as you move forward in time. So this whole process for us is predicated upon these two questions when we first meet with folks. Are you 100% sure that you're going to have a great retirement? And I don't know anybody that can say that. And if we could get you out of debt in 9 years or less, including your mortgage, without you spending any more money than you are today, would you be interested? And the truth is, on that second statement, what we're actually seeing is it's not just 9 years or less. It's how much earlier can it be? So if you've got 30 years of debt and it ends up coming to 9 years, then we just saved you 21 years of debt. So really what we're seeing here is anywhere from 3 to 27 years. That's what I'm seeing when I run these illustrations, getting new people out of debt 3 to 27 years early. If you're like most Americans, this is what your income looks like. 74 cents of every dollar you spend is spent on interest and taxes. And it doesn't need to be that way. And we're going to talk about taxes a little bit later on as an advanced market strategy for how to use a DFL program. But mainly what we're looking at here is, when you think about as a consumer, how much money you make and how much money you have to spend, that lifestyle sliver, that roughly 1/4, 23%, that's it. Everything else that you spend is either a minuscule amount going towards savings, which is certainly not enough, a major amount going to pay taxes. That was definitely not the founding fathers' idea of what this country should be like, or about 34% of your dollars going out for interest. And the reason why that is so onerous is because we're taught from a very early age that it's okay to take on debt. And that's the biggest issue looking at this country right now. The income levels have not gone up that much, but housing's gone up 400%. And it's insane. And we're definitely not on the right track. The one thing that we have though, is we do have these debt-free life programs. And this is a way out, an alternative to what you're currently doing or what you've been taught. The problem with the way we as Americans are grow up and taught is that we make good income. As you can see, the average American makes $2 million in their lifetime. Problem is we don't save enough. We're saving only $60,000, which is what that previous sliver on the last side represented at 3%. That's not enough. If you think for a second, how much money you make right now, and then you retire, maybe you're going to reduce your expenses by 30 or 40%, which is great. But if you reduce your income by 97%, that reduction of 30 to 40%, it's not going to last long. So we have to do something. You have to change, and it's for me, it's a scary proposition, being able to consider that I might have to rely on Social Security, because at this rate, there's no guarantee that Social Security is going to be around when I get there. So moving on. When people first discover they've got problems, it's usually revolving around some kind of debt, and the concepts that are taught typically by debt consolidators and debt refinancers and people that are going to go negotiate your debt. These are those 6 bullet points on the right side of your screen, and unfortunately, all five of those 6 fail with regularity. The one that does work with consistency is that debt snowball. As long as it's a true debt snowball, and as long as the person using the debt snowball financial mechanism is disciplined in maintaining the use, the way that they're structured, the way that they're taught how to use that. So there is a better way, and the better way that we can do this, it's still going back to that 9 years or less, but it's really, again, 3 to 27 years early, without spending any additional money. It's a fundamental change in the way you spend money. the way you think about money, the way you save money, the way you use money. And this is what we're going to teach you. How do we do it? Well, first off, let's talk about what our goal is. Our goal is to get you from the left side of your screen to the right side of your screen. Our goal is to make it so you're going to have a 500% increase in the amount of money you're saving for retirement. Now, granted, it's not going to be as much maybe, but it's going to be a heck of a lot better than where you're on track for right now. One other thing, the critical piece that we look at here is these programs would fail if it caused you to have to tighten your belt for too tight for too long. And that's why the way these programs work, it actually increases your cash flow, doesn't decrease it. Over time, especially, it's going to increase your cash flow. And that 10% difference in the lifestyle money, which is where your cash flow is derived, that 10% increase is not 10%. It's actually 43%. It represents a 43% increase in the amount of spendable money that you have when you're ready to start spending it. That reduction in taxes is huge. 25% reduction. Where's that money going? It's going into your pocket and it's going into your savings. And finally, that 34% interest down to 22% interest. That's huge. That's a 30 plus percent interest reduction in interest that you're paying over time. And again, where's that money going? Remember, we're not looking for you to spend any more money than you're spending right now. We're just looking for you to spend it smarter. So that's where we're getting this money from. We're going to change the amount you spend on interest and taxes and take that money and put it right into your coffer, right into your pocket, right into your pocketbook or your checkbook, and also create that much larger, much more secure tax-free retirement income that we're all looking for. So once we've moved from that left side of your screen to the right, and we're now embracing the right side of the screen model, we've already talked about this. We're going to reduce taxes over time. We're going to reduce interest. We're going to get you out of debt. We're going to improve your cash flow. We're going to significantly supersize the amount of money that you're saving for retirement. And one more thing, as Mark mentioned earlier, this is not new. These programs are not new. They've been around for a while, a long time. Rockefellers did it, the Rothschilds did it, and some other people we're going to show you in just a minute. The problem with the programs that came before us is that there was not an emergency fund. They did not consider what happens if you die too soon. What happens if you retire too early? What happens if you're forced to retire? What happens if you become sick, injured, disabled, and can't work anymore? So our emergency fund, it's there, it's available, and it is there if you really need it, but we want to make it very difficult for you to get to it. So if you have a need to get to your emergency fund, it's going to be painful, and that's by design. But the important part that you'd miss, that we're maybe not missing, the important part here is that we're going to create that 80% massive amount of cash available for you. And we're going to do something that we call dollar cycling, where we're using the same dollar over and over and over and over again, building up a loan, taking the loan out, paying off the loan, taking the loan out, just using the same dollars over and over and over again. And in the process of creating this emergency fund, we create a system that's probably 99% effective. The only time that I can see that I've seen so far where the program has failed is there's a reason why professional athletes, after they stop playing within 4 or 5 years, are typically broke. There's a reason why people that win the lottery are typically broke within 3 to 4 years after they receive their winnings. And that's because they don't have the discipline to spend money correctly. If you all of a sudden, if you've never had money in your life, and you all of a sudden have available to you simply with a phone call or going to an online portal and having a direct deposit made of $40,000 or $50,000, you're probably going to be able to talk yourself into, I need that new car, when you don't need the new car. I need that fresh trip to wherever it is in the world I want to go, when you don't need it. So that's the danger that I see with these programs is for people that are not astute or not familiar with handling larger sums of money and having them available to them at their whim. As long as they stay focused, though, and stay on the straight and narrow and follow the plan, it'll be fine. But if they go off the rails, well, that's what we're here for. Agents and brokers, we're here to help you get back on track. So when we compare these programs to different types of retirement programs, I don't know about you, but for me, the most beneficial, the most desirable type of tax program for me is a tax-free retirement program. And that's exactly what this system is. It represents a tax-free retirement program. And so when you take the same type of investment, a $10,000 investment, and you look at a 28-year return at an average interest of 7% per year, assuming you're only going to be at a 25% tax rate, which if anybody has that illusion, you need to check yourself. The reality is this program, there's no way this program cannot outperform a tax-deferred program, whether it's a 401, 403, TSP first, it doesn't matter, or Roth even. It's going to outperform a tax-deferred program. And if it happens to be a tax program, like you're just putting money in a savings account and getting that really poor interest, then it's going to way outperform that. The biggest concern I get from people is liquidity. This is significantly more liquid than what you have in a traditional IRA. It's not as liquid as what you get in a savings account. But when I say that, I mean, you've got probably an additional 3 to 4 business day delay before you can get your hands on the money. That's it. So to lose 3 or 4 days of having available access to my cash, but having that 41,900 to 66,448, I'll take the 66,448 every day of the week. I'll wait my 4 or 5 days to be able to pull my money. It's a no-brainer. Moving on. So this, like all financial instruments, works in phases. And the initial phase is called the maximization phase. That's when we're building the cash value in your program as quickly as we can by eliminating the debts that you have as quickly as we can and really utilizing that debt snowball, allowing the previous debt and the elimination of that debt, the money that you were using to pay debt service on that debt, allowing that to come back into the program and now be used to pay off the next debt, and then the next debt, and then the next debt. And it creates that snowball effect where we're all of a sudden something was going to take us 3 years to pay off or 4 years to pay off, like a car. We're now paying it off in 19 months. And that credit card that we're going to be paying on for the next 10 years, we're paying off in 12 months. This is something that we see as a very common effect of a DFL program being utilized and being followed. When we get out of the maximization phase, that's when we're flying. That's when our debt snowball is as large as it's going to get. We're putting as much money as we can into the program every year, and we are doing nothing but accumulating cash, accumulating wealth to get us to the end, which is that distribution phase. And that's where you can go take that emergency trip wherever you want. Because it's your money, you do with it whatever you want to do. You go wherever you want to go. Distribution phase is where we should all be when we're ready to retire. The important part of that is that when you compare this model to a 401k, a standard IRA, the tax implications are huge. In the 401k model, you're growing your nest egg, but you're also growing your taxes at the same time. In this model, we've eliminated the taxes at the beginning. We're using what's called non-qualified money to buy the program. That means we've already paid tax on the money. So we're not growing a tax obligation. We're not growing tax exposure. We're not putting ourselves in a place where, okay, I earn 10%, but I also have to pay 4% in taxes. We're eliminating that. And when we finally take the money out of the program, it's coming out either as a death benefit, tax exempt, or it's coming out as a loan, tax exempt. So our retirement distribution is going to be a tax exempt retirement. No, by the way, I don't have to wait till I'm 62 to take it. I'm not required to take it when I'm 72. I can use the money for anything. I don't have to prove a hardship. And the only person who makes the decision as to whether or not I can take the money, me. Okay, moving on. I mentioned that there are people that have been doing this for a long time. The Rockefellers, Rothschilds, Chase, big banking magnates, all those guys back in the late 1910s, 1915s, 20s. But these are other people that you know. These are modern era people that did this and are doing this. Walt Disney, Ray Kroc, Doris Christopher, Warren Buffett still does it to this day. It's just a smarter way to spend money. It's a smarter way to save money too. So we talked about this before. We're going to borrow money when we take money out. So there's no tax obligation, no tax exposure. We're going to repay money, repay the loan, maybe. We're going to use the system to repay the loan for us, maybe. Every person's program is unique, so make sure you get with whoever invited you here and work up those programs. There's a lot of opportunity here. Don't forget, this is just a plan. It's a program that works, but life's going to happen. And if you end up running into something new, like you need a new water softening system for your house, or your transmission dropped and you need to get a new transmission, it's okay. Use the system. It's a private bank. It's there for you. You own it. Use it. All right. So first thing I want to do, these are some people that we do these programs with. Those numbers are actually pretty light from what we see these days. The numbers I'm seeing are certainly 6 figures, and in some cases 7 figures of interest that we're retiring, depending on what it's being used for. Okay, let's talk about how you spend money. First things first. So when you get paid, you take that money, you deposit it as a paycheck, or however you're getting paid, direct deposit, whatever, it gets deposited into your bank, as Wells Fargo, Citibank, Bank of America, whoever you bank with, doesn't really matter. That bank is happy to take your money because that's what they use to lend money. And they take your money and they lend it out over and over and over and over again. So they're making money with your money daily. The average dollar you spend or you put into your bank stays there and is lent out by that bank 7 times before you actually use your dollar. And does the bank give you anything for that? In some cases, they might give you a free checking account. In some cases, they might just give you a thank you for keeping your money with us because you've got so much money with us. We're not going to charge you to keep your money with us. Thanks. Okay. And then ultimately they make money with your money, and then you tell them to pay your debt. And what's happened? You've transferred the money through your bank to your creditor. You've traded cash for equity or elimination of that debt. You have a net zero sum gain. And the only person who's winning here is your bank, because they're making money with your money over and over and over again. And so I said, we're going to show you a better way. Here's the better way. Same money, same deposit goes into your bank, but here's where things change. You're going to delay or I guess divert some of that money depending on how large your life insurance policy is. And they're going to pay your life insurance premium, which, don't forget, this program is based on whole life insurance, specifically participating whole life insurance, which is different than traditional whole life. The whole life insurance policy allows us to participate with the profits of the corporation, of the mutual company that offers this to us, which means we can earn a significantly higher interest rate than we can in a savings account. Most banks, most money markets even, you're going to get better return, and we're not going to have a taxable event. We're also going to have a term life rider. This is something we were talking about earlier with the new changes that are coming in January. This is going to get smaller. The need for this is going to get smaller. But right now, we still have to have this term life rider in the program, because that's creating an umbrella that the IRS can't see through. That umbrella is allowing us to grow cash underneath. And that cash that we grow is also, remember, participating whole life. The cash value that we're growing in this program is getting applied an interest rate, and it's getting applied a dividend. And those two things in combination are creating a fairly hefty annual return for us that is not linked to market growth or market decline. It's completely immune from market oscillation, and it's guaranteed. The dividend isn't guaranteed, but the companies that we use have paid a dividend every year they've ever been in business. Is it safe? Well, let's see. They've paid a dividend through every war, modern war that we've been through, every pandemic, every good president, every bad president, every policing action, every civil unrest and turmoil that we've gone through in our country. They've always paid a dividend. So for me, looking at that, that's a pretty safe bet for me. And then the other thing that I get asked a lot is, well, how safe is it? It's not in a bank. Well, I would ask you this. Can you name any banks or investment companies that have failed? Bear Stearns, Lehman Brothers. Yep. Can you name any insurance companies that have failed? I can't. And that's the reason why, is because insurance companies are the most profitable company on the planet. So remember what I said earlier. Participating whole life, you're able to divert money out of your checking account, put it in a place where you're going to participate with the most profitable companies on the planet and get paid an interest rate plus a dividend. All right, finally, paid up additions. So when you pay that single premium for your whole life, there's two specific riders. Term life, we already talked about that, creates that umbrella. Paid up additions, what is that? The carriers, when you buy a paid up additional life insurance, that's considered in banking terms a tier 1 asset, which means it's the safest kind of investment that you can find. Why is it the safest kind of investment? Because you only have to pay for it once. It has permanent value that's not going to decline, and it doesn't cost any money to maintain for the most part. So if I've got something that's worth $10,000 today, is it going to be worth $10,000 tomorrow? If it's a paid up additional life insurance, yes. If it's stock, no. If it's gold or silver, no. Paid up additional life insurance, yes. I know what it's going to be worth. And that's critical when we're looking at this for long-term use. You know, I don't know how much my 401k is going to be worth in 20 years. I don't know how much that 20 pounds of silver bullion I have in my safe is going to be worth in 20 years. I know exactly how much my debt-free life, paid up life insurance is going to be worth in 20 years. And I can make my plans accordingly. So remember that circle just a minute ago where the bank was making money with our money every night overnight? We've moved it. We've now put it over our life insurance policy, which is actually our DFL bank. We are able to make a regular return on this, in some cases compounded monthly, in some cases compounded annually. And we're able to continue funding, making money from this. But now, how do you use the program? Where's the rubber meet the road with use of the program? And it's simply this. You'll get to that point where you need to pay off your car. You need to pay off a credit card. You need to pay off your mortgage. And what do? You take a loan. You tell the carrier, hey, Mr. Carrier, I've got $20,000 in my program. I owe $11,000 on my car. Send me $11,000 so I can pay off my car. So you take a carrier loan. The carrier says, okay, we're going to wire the money and deposit it directly into your account. Gets deposited back into your checking account. Your bank starts rubbing their hands together. They're all excited. And all of a sudden you take it out of that checking account because you tell them to go ahead and pay your debt. So they pay your debt. And then all of a sudden your debtor, your creditor is paid. And do they care where the money came from? They don't. Do they know where the money came from? They know it came from your checking account. Are they satisfied that their debt has been paid? Yes. Is this a net zero sum gain? No. Why? Because you eliminated the debt, which is now their money, but your money is still sitting in your DFL bank, earning an interest rate, which is guaranteed, and earning a dividend annually. And as you continue to fund your bank, you're going to cycle through those dollars. You're going to take money out, pay it back, take money out, pay it back. And as you're paying it back, you're going to recover, in some cases, some of that interest that was charged up front. And in the end, you're going to come out ahead. How far ahead? Further than you can imagine. So let's move on and let's see a real example of this. So here's a family that I did one of these programs for. I need to update these. This was done 2 years ago, almost 3 years ago at this point, getting close, 2 years ago. This family was a mixed family. They had both been married before. They both had houses they brought into it. One of them was a college student working on her doctorate, and the other was a truck driver who owned his own truck. They had a lot of debts, some old taxes, medical bills, credit cards, student loans, all that kind of stuff. When we asked them how much debt they thought they had $584,000. That's not true. The amount of debt they actually had was $767,000 after you talk about the interest they're going to be paying over time for that debt service. So in this scenario, certainly when this was shown to them that their debt was actually almost $200,000 more than they thought it was, of course their jaws dropped. But that's reality. And the reality is student loans are evil. And because of the way these were structured, she's got 40 years to pay off the student loans. This is what our system did for them. We got them paid off in 7.8 years. They are now starting year 3 of their program. And so what that means is they've already processed through all of these first 15 months of things. So they've eliminated most of their debt, most of their smaller debts at this point. But more importantly, something I want to point out, their debt snowball is now $1,418 a month. That means they're not spending any more money than they were spending before. But that $1,418 a month they were spending as debt service, they're now using it to pay off their previous debts and their next debts and create a nest egg for them in the future. How much of a nest egg? Well, they started owing $182,000 of scheduled interest. We got them out of $70,000 of their scheduled interest. We got them out of their debt 32.2 years early. And in the process of doing that, creating an environment where they're going to be able to capture $4.8 million of liquid cash over time. That does not take into consideration the equity that they've got in their properties. It also doesn't take into consideration the fact that they're going to have a paid up life insurance policy in the end that's going to be worth about $1.1 million. How does it work? Each one of those years where they're paying off a debt is represented by, it's highlighted in yellow. You can see that in year 4, there's no yellow highlight. That means in year 4, whichever the next debt is to be paid off, there's not enough cash in the program. You can see the cash that they borrowed was $96,000. So they only had 91 at the end of year 4. So probably fairly early on in year 5, about 2 months, maybe 3 months down the road, there's enough money in this program to pay off that house. That was a second house. The next year, they're paying off their primary mortgage. 2 years later, they're paying off that disgusting student loan. So what I'm showing you here is on the track that they were on, and they were overpaying some things, taking out extra money, paying an extra $20, $50 here. All that money they were spending previously that they were paying to overpay those debts is gone forever. It's never coming back. They're never going to see it again. But here, they're able to use it and cycle it over and over and over again. So in 11 short years, they're up to $375,000 cash. All their debts paid off. All that interest is eliminated. And they are on a rapid track to get a massive retirement. When I spoke with this gentleman, he said he wanted to retire at age 75 because he was never going to stop working. And I said, okay. But with this program, I showed him, you can retire at age 55, 20 years early, and you'll have $1.5 million cash in the bank. A couple of key things to look at here. Number one, and this is why we, in many cases, when we start one of these debt-free life programs, we're going to start 2 of them at a time. In this illustration, in year 11, we've got too much money going into the program, $11,000 too much. So this, what that represents here, that's $11,000 they were going to have to put into some other kind of savings vehicle, whether it's a savings account, another DFL program, ding, 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 or something else. So in this scenario, my recommendation is always going to be to start a DFL program, but do it now. Start with a convertible term with the same carrier that you're going to run this policy through. And then when you reach that point, you've already got the term policy in place. You've already been through underwriting. You can just convert it into another one of these DFL programs. So you're already set up, you're already through underwriting, and you just go, just rock and roll with it. So what happens if you don't have those kinds of debts? What happens if you're a student? Does it work for students? Absolutely. So I heard somebody say the other day that this doesn't work for people with only one debt. And to that I say, absolutely not. It works with anybody. Whether you've got 0 debts, which means you're starting off in the accumulation phase, or if you've got only 1 debt, which means the debt snowball is not going to be very fast, but it's still going to work. It's still going to cut your mortgage in half by about half. In this scenario, this was a college student that she had a lot of debt, but didn't really own anything. She owned a car. Other than that, a couple hospital bills, and then all those other loans that you see there, those are all student loans. Student loans are evil. In this scenario, she had $177,000 in payments she was going to make for a total debt of only $85,000. Why? Because student loans are evil. She was going to be paying $91,000 in interest over time. So at 23 years old, she was in pretty good shape, but with this program, we were able to get her out of debt in 9.7 years. Now look, this is based on a waitress's salary, a waitress's income. This program was funded at $350 a month. Not very big. Didn't need to be. But this is also assuming the illustration we're showing here right now. This assumes she's never going to finish her degree, which she already has. This assumes she's never going to get another job other than working as a waitress where she can afford $350 a month, which is not the case because she's making over $90,000 a year now. And this assumes that you're just going to follow this normal path and pay it, 9.7 years. And she's not. She's now overfunding it to the max. She's putting in over $1,100 a month into the program. And she's not going to be out of debt in 9.7 years. She's going to be out of debt in 6.7 years. That's what these programs can allow you to do. The flexibility, if you structure them properly, to add more in later on, just taking into consideration what the debt snowball is going to be. So for this young lady, she was 23 years old when we did it. That means at the age of 40, she was going to have $603,000 liquid in the bank. And she's going to have another life insurance policy that was paid up at almost $400,000. That's certainly a nice legacy money. And I can't give you the new illustration because we haven't run it yet. But this program, when she told me she wanted to retire at 65, we said, nope, you're going to retire at 55. So at age 55, this program is on automatic pilot. You guys get that? So between age 65 or 56 and 57, her program grew by $6,000. That was her death benefit, and she didn't pay a dime. Her cash value grew from 454 to 477, and she didn't pay a dime. $23,000 increase. So what did she do here? She essentially created herself a $20,000+ a year income, tax-free for the rest of her life. So will this work for you? I've seen very, very few people that it wouldn't work for. The only ones that I can say with regularity that it will not work for are people where their debt service is so high that they can't afford to start one of these programs. And really their best option at that point might be bankruptcy. At this point, thousands of illustrations that I've run with this, I can honestly say I can count on one hand the number of people this wasn't appropriate for. So with that, I'm going to stop for a second. Make sure when we get through today, talk to whoever invited you. Look at doing one of these things for you. Take the time, fill out that debt-free life financial analysis form. All right, be honest. All right, we're not judging. We're just here to help. So that being said, I'm going to stop for a minute and see if anybody's got any questions. See some in the chat. All right, so for everybody who needs to reach Mark, his contact info is in the chat. So make sure you reach out to him. He's an excellent guy to work with. Okay. I don't see any other questions. Anybody else have any questions before I move on to the tax stuff? All right. Mr. Desario said, okay, so we're moving on. All right, taxes. So if you're in any kind of a 1099 situation where you work and that's how you get paid, then taxes are a big concern of yours. Whether you pay monthly, quarterly, or annually, you should be saving 20 to 25% of your income to be able to pay taxes. One of the ways that you can utilize a DFL program, not as a primary funding source, as a backup funding source or a contingent funding source, is you can take that tax money that you would normally be paying every month, and if you're able to pay quarterly, then don't pay monthly. Pay it quarterly, but pay your money into your DFL. So this is a scenario for one of my clients. He makes a good amount of money, pays about $20,000 a year into for taxes. So what we were able to do is capture that $20,000 a year into his DFL program. So where we're looking at here, this is a year one. At the end of the first year, just like all programs, because there's an upfront cost to get this stuff started, there's actually a loss. He saved an additional $20,438. Okay, he's paid all of his taxes for the year, but the debt service and the loans that we looked at this are actually costing him about $513 a year. So for me, even if it costs me $513 every year to save $20,000 every year, it's insane to not do this, okay? Because in year two, it doesn't matter anymore. So in year two, what's happened here is that $20,000 that we saved in the first year is starting to have compounded interest applied to it. And if we're cycling through our dollars and we still have a program that's paying in and we're still building PUA, then not only are we cycling through our dollars and building that, capturing that $20,000, we're paying down the previous loans that we've taken. We're recapturing some of the interest that was taken up front. And now we're adding another $20,000 that's going to be applied, that interest rate plus the dividend annually. And now, instead of it costing us $513, we have a net gain of $316. Not a lot of money, right? But if you had the opportunity to gain $316 or lose $20,000, gain $316 and capture and sequester $20,000, why wouldn't you? Year three gets more impressive. Yeah, see that little star sign? That means it's too big to show. So in year three, now we're making four figures. Okay. Is $1,177 going to make that much of a difference for anybody who's having to pay $20,000 a year in income tax? Maybe not. Maybe so. But if you do this for 10 years, then you're earning $8,172 a year. And you've captured and sequestered $242,000 additional money into your DFL. So let me ask you this, Mark Creighton. If you had the opportunity to pay your taxes on time and pay them every year and have zero left over, or pay your taxes on time, pay them every year, and have $242,000 sitting in your private DFL bank and earn $8,172 a year interest on it, which one would you choose?
I think the answer is simple.
Yeah.
Show me the money.
Yep. So there you go, guys. That's how you can use and incorporate a DFL program. If, remember, here's a critical part, this cannot be the primary funding source of your DFL. If you use this as the primary funding source, you'll never get ahead and you will probably lose and the program will probably fail. So, and I'm also, one more thing, if your DFL program is $100 a month, this isn't going to work either. But if you're paying $20,000 a year in taxes, you should be able to have a larger than $100 a month DFL. All right. So I'm going to open this up for questions. We might actually get finished early today. So let's see. I don't see any questions in the chat. That's awesome. You guys get it? You understand it? We don't have to do anything. No questions.
So would this be a separate policy from your DFL policy or added into your DFL policy or what?
So when you're structuring these programs for the client, then you need to look at what the client's going to need in the future. Look at what their snowball is going to need, and then have that candid conversation, that frank conversation. Do you want to be able to save your tax money? Do you want to be able to use this as a funding strategy to store taxes and have that money grow for you? And if the answer to that question is yes, then that primary DFL, you just need to make sure the PUA is large enough that you can capture whatever it is, $20,000 more than the debt snowball, $30,000 more. And that's how I do it. Could you do a private DFL just for taxes? Again, the funding, it cannot be the primary funding strategy. Just like if you use this for the home escrow financing, it can't be the primary. It can only be as an adjunct because your debt fee life has to work and flow on its own. Okay. That help you, Maureen?
No.
Nope. Sorry. You should
So
not.
you put it in the original policy, but you have to be diligent about how you run your money.
You put in $5,000, you take out $5,000. So it's going to be a wash. You're going to be cycling through it.
Okay.
If you don't have a DFL that's set up, then that will eat itself over time. And you'll get to the point where you're putting in 5,000, but you can only take out 3. And now you got a tax problem. So that's why I'm saying it cannot be the primary funding source. Primary funding source has to be able to, in gambling terms, it's called juice. You have to be able to cover the juice that you're going to lose with the primary DFL for a while. Though a while is 1 year, because in the second year, the compounded interest has kicked in and now it's supporting itself.
Okay.
Okay. Does that help?
Helps a lot.
All right. Anybody else? Mark, you were shaking your head like you understood what I was talking about.
Yes, absolutely. In fact, I might add, Lorraine brought up a great question. How do I structure? What are the options? Your point is absolutely valid. And what I saw was the 20,000 he was paying in taxes. That's funding the PUA. So on top of that, he had to pay for the death benefit. Tying in some things that I've learned along the way in the IBC world, as a business owner, you can structure it as a personal policy as long as the guy has the capacity to hold additional death benefit. And since DFL policies aren't maximizing death benefit, most of the time you're going to find that there's room to do it. Tying into previous conversation about 7702, with less death benefit policies, this is going to become easier to do as well. Advantage of owning it on an individual basis, consult with your business owner's CPA. Please, I am not a CPA. I cannot give tax or legal advice, says high compliance. What I've seen in practice is the individual owns the policy individually, loans money to the business because the business has to pay the taxes. You write up documentation, a legal document that you can go to the CPA and prove it out later. I'm going to lend the business the money at 10%. The business is going to pay me back 10%. I've got to pay taxes on that 10%, but I've got a write-off for the interest mutual trust charged because it was a business loan. So I'm going to pay some income tax on the gain. That's fine. I'd rather pay income tax on a smaller amount. But the business, you just figured out how to get some money out of the business on a tax preferred way for the business because they're writing off the 10% loan. Now there's some regulations in how much you can charge your business. It's usury rate, normal usury rates.
33%.
Yeah, you can't go crazy, but it's a strategy that's used. If you want to hold the policy inside the business, I caution, let's have a conversation first because there's some limitations on death benefits, depending on how you structure that policy. If it's key man, executive bonus, or buy sells, there's a number of different ways we can do that. We just got to be careful of the death benefit. So depending on that tax bill they have, worth the conversation going into it. But this is such an excellent strategy and just another one of the infinite number of ways that this policy can benefit your clients.
I would add one more thing to what you were just talking about, the executive perk, executive bonus route. Tax Code 162 allows for that to be a write-off by the corporate level, at the corporate level. And if your corporation is structured correctly as an S corp, then you're going to pass that tax loss or that loss from the corporation directly to the individual. And if the type of S corp that you have, if you're a principal in that S corp and you get to write off the K1 that comes down, then you have in essence created an environment where you can take that program, your corporation can pay for that program under 162, pay for it, take the write-off goes on to a K1, the K1 passes to the individual at the end of the year. The individual has to claim the life insurance as a bonus, but then they get the write-off from the K1. So that actually makes it a zero cost tax exposure deal. Talk to your CPA. Right?
Absolutely. And if you don't have a CPA you work with, that sounds like an excellent strategy. Go befriend one. Show them what this DFL program does for him and for his clients, and partner with some businesses because I'm certain they know some.
Yep. All right. Anybody else have any other questions? Yeah, Brett, send me an email. I'll send you a copy of the spreadsheet. Wow, we finished early tonight, guys. Anybody else? Going once? Going twice? Come on.
Thank you so much.
Right on,
Appreciate
guys.
this, Scott. And thanks, Mark, for your time. Good to see everybody.
All right, we'll be back in a couple.